Okay, Jason, you're up. Jason, you're up. Thank you.
All right, so let me see if I can share my screen with you. So I can do that, and let me get to the very top of the presentation here. All right, so let's talk a little bit about what's going on in the economy. Let me see if I can put this to full screen for all of us. And again, my name is Jason Schmidt. I'm from Chandler Asset Management. I don't think I've met some of you before, so it's a pleasure meeting all of you. I am a co-CIO here at Chandler Asset Management. Most of the time I'm spending is with your staff, looking at the portfolio, proposing investments, and then basically recommending those investments. And also I have here is Elena. So Elena is a newer member with our team. She is a strategist and is someone that you'll be seeing in the future as far as looking at the portfolios and things like that. So let's talk a little bit about what's going on with the economy today. And so a lot has been going on since the last time that we spoke. So we have a couple of things, just some bigger items that have been going on. One is the Russian invasion of Ukraine. And so, the tragedy that is going on over there is, insurmountable. And there are a lot of different impacts, some of those being the humanitarian impacts, but also there is some economic impacts as far as looking at the globe. And so part of that, what's been going on is we've seen a rise in commodities prices. And in particular, most of us here have seen the rise in gasoline prices as a result of this. Remember that Russia and Ukraine were big natural resource providers, and Russia being a big energy provider, not only for crude oil, but also natural gas, and in particular to Europe and places like that. And so when you're looking at that, basically you're seeing those inflationary impacts. And so looking at what's going on over there, that's definitely have an impact here in the United States. Also, we have the Federal Open Market Committee, or the Federal Reserve. So the Federal Reserve, this was a little bit dated, considering that the Federal Reserve just finished up its meeting about a few days ago, and it's continuing to raise interest rates. So interest rates at its March 16th meeting, it raised by 25 basis points, or 1/4%. And then looking at the most recent meeting, it actually increased interest rates by about 50 basis points, or about 0.5%. It's doing this is because we have very high inflation here in the United States. We have inflation that's over 8%. That brings us back to the Reagan administration as far as when we look at some of those year-over-year numbers. And we did get a most recent number of inflation where it has come down on a year-over-year basis, but still we're above that 8% mark. And so we'll have to see kind of moving forward how that goes, but definitely the Federal Reserve is fighting that by raising interest rates and reducing monetary accommodation for that. And then if we look at where yields have been, looking at in March, we definitely have seen an increase in yields. One of the things that we have been doing within the portfolio, and we can show you a little bit later, is essentially looking at the portfolio. And we have not invested all of the money in longer term securities, but been slowly investing that money. That has definitely been a benefit to the portfolio. As interest rates have continued to increase, we've been capturing those higher interest rates over that period of time. And then looking at employment, so looking at non-farm payrolls. So here you can see just the month-over-month change in non-farm payrolls. So the dotted dash line there is the 3-month moving average. The green line there is really the headline number. We're continuing to add jobs, meaning employment continues to remain strong. And in addition to that, if you look on the right-hand side, you can see the unemployment rate. The green line there is the headline unemployment rate. The dash line there is what we call the underemployment rate, which are those folks that might be working part-time but would like to be working full-time, is an example of that. You can see that those have continued to trend lower there. Notice that this is a 2-year graph. And so it goes back to March of 2020. Remember, that's when the pandemic struck. It's really hard to believe that that's been almost 2 years now since that's happened. And we continue to see that, the employment situation continues to be very tight as far as just looking at the labor market. As we move forward, you can see inflation, looking at CPI. And so the dash line there is the year-over-year basis. The green line there on a core basis, meaning that's excluding food and energy. The green line there is the headline number. And And so you can see that continues to increase. And then if you look at the right-hand side, you can see the personal consumption expenditures. And so when you look at the personal consumption expenditures, you can see that trend is also in place, where we continue to see on the dashed is the core, meaning ex food and energy, and the green line there is the headline number. So inflation remains a concern, is really what most market participants are looking at today, is looking at the inflation numbers. And that is definitely what is causing the Federal Reserve to really start to pick up the pace of its rate increases. In particular, if you look at the Federal Reserve where it was maybe in December of 2021, where it is today, definitely looking to have future interest rate increases. They will have a meeting in June and also July. Those are kind of the next two meetings that are coming up. And our expectations is that they will continue to raise interest rates until they see inflation start to abate. And so we'll continue to monitor that as it relates to the portfolio. When we look at the consumer on the left-hand side, retail sales on a year-over-year basis, you can see that retail sales are doing very well here. One of the items to remember when you're looking at retail sales, and you can see from probably February 2021 to where we are today, essentially that you're looking at retail sales that are north of 10% there. Remember that these are not inflation adjusted. And so as prices have gone up, you also have retail sales that have gone up at the same time. And so you may be selling the same amount of widgets, it's just that you're selling them at a higher price. So that's one thing to keep in mind when you're looking at retail sales. On the right-hand side, you can see consumer confidence. And so you can see consumer confidence there over the last 2 years. You can see that right now, it has fallen a little bit, but continues to be at levels that are really consistent with the economic growth. As we move forward, looking at the leading economic indicators, so on the left-hand side, you can see the month-over-month change. And so you can see that we had back in January where it actually went negative, but then that's come back a little bit. And then when you look at the right-hand side, looking at the Chicago Fed National Activity Index, remember here that you want to look at the 0.7s. Anything above 0.7 is expanding, anything below 0.7, the economy is not expanding at a good rate. And what you see here is on the 3-month moving average, you're definitely above the 0.7s. What these two indicators lead me to believe is that we will continue to expand as far as the economy is concerned, at least probably for the next 6 to 12 months. And so we don't think there's a big danger of a recession coming anytime soon within that time period. And we really get that from some of the economic indicators that we showed before, and also these indicators here. As we move forward, you can see looking at housing on the left-hand side. So the green line there is single family homes, and the gray line there is multifamily homes. And what you can see there is really, we continue to see housing starts to do very well. You can also see on the opposite side of the page, you can see looking at housing prices. So this is looking at the Case-Shiller S&P 20 City Composite Home Price Index. This is really looking at year-over-year changes and housing prices. So you can see we kind of peaked out there as far as the year-over-year changes, July 2021. And then you can see that it drifted down a little bit there, and then we're back on the way up. I think there is going to be a little bit of a slowdown as far as the appreciation of prices. When we look at mortgage rates today, mortgage rates are between 5.25% and 5.5%, definitely increased between 200 and 300 basis points, or 2 or 3%. And so that is probably a headwind towards housing moving forward. There still remains strong demand, but definitely it's going to cost more to finance that house. And so we continue to see strong demand for housing, but it is likely that we're going to see maybe the price impacts cool off a little bit from there. And then looking at manufacturing, so looking at the Institute of Supply Management, so anything above 50 is expanding, anything below 50 is contracting. And so what you're looking at here is really in the Institute of Supply Management that we continue to have an expanding manufacturing sector. We do not foresee that coming down materially from where it's at. We continue to see that the economy continues to expand at a pretty good pace. And then you can see industrial production. So you can see here on a year-over-year basis, so you can continue to see that moving forward there. And so you can see that year-over-year pace is actually starting to accelerate a little bit from where we were before. So in general, I would say that the manufacturing sector is doing well. This is looking at gross domestic product. And so looking at that, you can see the table there. And so what you can see here is the last 4 quarters. If you look down below there, you can see those total 6.3%, 6.7%, 2.3%, and then 6.9%. The most recent reading in the first quarter was negative. So that was given about a week ago. So we don't necessarily predict that to be a recession. There were a lot of different numbers within that number. We had a big inventory build back in the fourth quarter of 2021. So there wasn't as big of an inventory build that happened over that period of time. So we don't think that that's necessarily recessionary. We think it is actually some smoothing out of some of the numbers that we've had. And then if you look on the right-hand side, that is looking at a graph of the gross domestic product. So you can see the green line there is the quarter over quarter changes, and then the maroon line there is the year over year change. And so you can see from that standpoint kind of how the economy is developing. Then looking at the Federal Reserve, so you can see just looking at the balance sheet assets. So one of the things that the Federal Reserve has also been doing is remember that it was purchasing securities for its own balance sheet, U.S. Treasuries, and also mortgage-backed securities and debt. So the Federal Reserve stopped that program back in March, so they're no longer purchasing any debt, and actually they're going to start reducing their balance sheet. And so they're going to start off at a slower pace and accelerate up into the summertime in the next 3 months of about $95 billion per month, in which they're going to reduce their balance sheet. They're going to do that by allowing securities to mature off. So that would be agency mortgage-backed securities and also Treasury securities. So they'll allow those to mature off their balance sheet and will not replace those securities up to the amount of about $95 billion in total. So what does this really mean to the overall economy? It really means that the Federal Reserve is reducing monetary accommodation, not only through raising interest rates, but also reducing the amount of securities it is producing, thus putting potentially some pressure on higher interest rates, which will help to cool the economy. And then looking at the federal funds rate, you can see there, so looking at that federal funds rate, so you can see that that last increase that we had there, and then of course, we had the 50 basis point increase that took place just a few days ago at the end of their meeting. So the Federal Reserve is definitely on a different track than they were 6 months ago, and they are going to continue to reduce monetary accommodation within the overall economy. And then looking at bond yields. So on the left-hand side, you can see here looking at bond yields, the dotted line, there's 2-year Treasury notes, and then you can see the dashed line is 5-year Treasury notes, and then 10-year Treasury notes are the dark green line. And so you can see that increase in those going back to September. And then you can see looking at the yield curves, you can see the dotted line there is March, December was the dashed line, and then March of 22 was the green line. So you can see also how the yield curve has changed over that period of time. This presents some opportunities for some of these, the cash that we still have in the portfolio, as far as reinvesting that cash at higher interest rates, thus higher earnings for the city's portfolio as we continue to move forward. And with that, can I answer any questions that you have on the economy until we move to the next section, which is the portfolio?
Mayor Pro Tem, any questions? Jason, two issues that just dominate conversation are fear of recession and how much longer and how much of an increase we will have of inflation. Could you talk to concerns around inflation and recession?
Sure. So let's talk about inflation first, because that's really on the front pages of everybody's newspapers or news outlets. So if you think about inflation, really that's been caused by a couple of different items. One is we have an increase in commodities just in general from some of the things that have been going on. Second piece that's caused that is that during the pandemic, the U.S. was more service oriented as far as consumers. So consumers were purchasing more services. As we went through the pandemic, people were purchasing more things for their homes, just goods and stuff like that. So that also put pressure on commodities. So that's where a lot of this is coming from, is from some of those supply chain issues. Some of those are healing today, but of course we could develop some more of those supply chain issues as China continues to look at the virus, its sort of lockdowns in order to control those viruses, so that can happen. I would say that potentially we have peaked in inflation, in the sense that when we looked at the numbers today, they were better than what they were just a month ago on a year-over-year basis. And the reason why I say that is that we are starting to see things like used car prices come down from that rate of increase. Also, with the Federal Reserve increasing interest rates, that is likely to slow down the economy. Thus, when you have a slowdown in the economy, you are potentially going to see a slowdown of the CPI rate. I do think that the second half of the year sets up very different than the first half of the year. And I think think that what you're going to see is that you're going to see some easing of some of those inflationary pressures. I do not think that we're going to go back to the 1.5% and 2% that we saw pre-pandemic. I do think that we're in a different world, at least for the next 12 to 18 months. I do think that maybe you can get inflation down to maybe 5% or something as we close out 2022, but definitely we're going to continue to have that. As far as recession, there is some concern about a recession. I don't think the concern is in 2022 where you would have a recession, but potentially as you go out later into 2023. And the reason we say this is there's a couple of different reasons. One is that really the Federal Reserve is raising interest rates. Typically, as the Federal Reserve raises interest rates, typically it has overshot, meaning that it puts the economy into some sort of recession. I also think that there needs to be a distinction between the recession, between what recessions really are. Most of us harken back to a recession back in 07, 08, 09, where it was really not only a recession of economic activity, but also financial markets, especially the banking system, was sick and needed to be healed for the next 5 years or so. This time around, I think it might be completely different than that, where we would have a slowdown in the overall economic activity, but we may not necessarily see that those same sort of ramifications that come through the banking system, because the banking system is much more healthy because of the regulations that I've had today. So if we were to see some sort of slowdown, I don't think I'd harken back to kind of the 08, 09 scenario. I think I'd harken back to some of those recessions where we did see a slowdown, which is painful for all of us because we do see unemployment go up and some of those different things, but I don't think that we're going to see the same kind of recession that we saw in 08 or 09.
Thank you. That makes sense.
All right. Then let's take a look at the portfolio. And so when we look at the portfolio, it's really the objectives here are safety, liquidity, and then finally yield, and then really it's the performance objective. And so really looking at the rate of return over those cycles. And then in order to meet that, we purchase securities that are consistent with the city's investment policy and California government code. Here you can see that the portfolio fully complies with the investment policy and California government code. And you can see those on the next couple of pages. And I'm just going to point something out here, social responsible investing. And so the city continues to practice that. We continue to work with staff on approved issuer lists, and where possible, continue to look for bonds that really promote what the city is talking about within its investment policy. So we take that very seriously when we're investing those funds, and we continue to make that an objective as far as looking at the investment portfolio. Then looking at portfolio characteristics. And so I'm going to focus in on this table on March 31st. So moving left to right, you can see the characteristics we're going to look at, and the benchmark, and then of course the portfolio. So you can see the average maturity here is 1.76 versus the benchmark, which is 2.62. The duration is 1.68 versus 2.53. We still have a pretty significant portion in cash. And so we're deploying those into this higher interest rate environment, but definitely taking our time and looking for those opportunities in order to achieve the goals that we're looking to achieve in the portfolio. You can see the average purchase yield increased from 0.59 to 0.74. The average market yield was 1.72. It's a AA plus portfolio, and the portfolio is approximately $186.3 million. Then you can look at the sector distribution here. And so I'm going to focus in on March 31st, which is the graph on the left-hand side. So you can see that U.S. Treasuries make up about 40% of the portfolio. Supranationals make up about 2.6%. Negotiable CDs, 0.8%. Money market fund makes up around 13%. Think of this as funds that we have that are available to invest as we continue to invest into this higher interest rate environment, and we continue to do so on a periodic basis. Corporates are about 15.5%, agencies are about 25.4%, and asset-backed securities are 1.2%, and CMOs, collateralized mortgage obligations, are about 1.5% of the portfolio. Then if you look at the different issuers here, you can see the different issuers that are in the portfolio. And so you can see that government securities make up the largest portion. So moving left to right, you can see the issuer, the investment type, and the percentage, so that U.S. Treasuries and agencies make up the majority of the portfolio, along with the money market fund. And then you can see below there the different issuers that have been purchased into the portfolio. The negotiable CDs that are in the portfolio, all of those are less than $250,000, so they're fully insured by the FDIC for timely payment of principal and also interest. And then you can see the quality distribution here. This is on an S&P scale. So everything is rated A or better on an S&P scale. And then what you can see is those not rated securities are either rated by Moody's and or Fitch. So that makes them qualify per the investment policy. As we move forward, you can see the duration distribution here. Think of this as a maturity distribution. Your portfolio is in the green. The gray is that of the benchmark. And so you can see that within a 1 year period, you're looking at approximately 41% of the portfolio that will mature off. So as interest rates continue to increase, definitely it's going, as we purchase securities into that have higher yields, going to build upon that income that the portfolio is producing for the city. Then if you look at the duration distribution here, basically you can see that at that duration distribution, you can see that in the green, and then the gray is that as of December. And so you can see how that has evolved over that period of time. So we definitely have a little bit more upfront. Then if you look at total returns, so we have some negative total returns. So what does that mean? And so when we look at the graph above, your portfolio over the last 3 months is in the green. The benchmark is that of the gray. And so what does that negative total return means? Basically, what total return does, different than yield, is it basically looks at the securities and the value of those securities as of a date. And so what has happened, as we've mentioned before, interest rates have gone up. So some of those existing securities, when we take those securities and look at the value of those securities, have come down in value. And also we've earned income on this portfolio, but the income was not more than what the securities have gone down. We've had a dramatic increase in interest rates. Moving forward, as we continue to invest into some higher interest rate securities, we're going to increase the yield. And as yields start to abate, as far as looking at how they're increasing, we'll definitely return back to some of those more positive numbers. Also, remember, you have not realized these losses, meaning that these securities have not been sold. They've been basically marked to market. And so as we continue to allow them to mature off, we'll invest into some higher yielding securities, and this will pick up. I will point you to the table below and look at our performance versus that of the benchmark. And so if you look at below, over the last 3 months, your portfolio's earned 1.82% versus the benchmark, which was down 3.16%. So doing better than the benchmark. And then since inception, the portfolio has been down around 2.09% versus the benchmark, which was down 3.71%. And so doing better than the benchmark over this period of time. Definitely, we think that we're going to get back to positive returns as we continue to reinvest a portfolio and reinvest those maturities and also the cash. And so, and also as we continue to see where interest rates potentially start to level off from the levels that they're at. Most of those increases in interest rates that the Federal Reserve is being forecasted have already been embedded into the overall yield curve. And so what you're looking at today is basically investing out in securities that in some cases were yielding more than 3% today, which is a much better environment. Then looking at the reporting portfolio, and so you can see as of March 31st, you can see the purchase yield is 0.46%, the market yield is 0.46%, and then the market value was $123 million.
Right.
Here you can see how that's allocated, so local government investment pool and also LAIF. And you can see that LAIF and also CalTrust make up those percentages. And if you look at the consolidated information, so if you put the pieces that Chandler is managing on the city's behalf, along with the internal portfolio, you're looking at an average maturity of 1.06 years, a duration of 1.01, a purchase yield of 0.63, a market yield of 1.22, AA plus portfolio, and the portfolio is a large portfolio, $309 million. And here you can see the sector allocation, not too much of a change here, except for now you have big percentages in LAIF and also the local government investment pool.
Right.
Here's the holdings. I'm just going to go through these very quickly. Here's the asset-backed securities, the agency securities, the CMOs, the corporates, negotiable CDs, supranationals, and also U.S. Treasuries. And then you can see here, looking at the reporting portfolio, the LAIF balance and also the CalTrust balance. Here's some of those transactions that we looked at. And what you can see here is some of the purchases you can see in January, definitely all of those north of 1%. As you move into March, you can see all of those north of 2%. In fact, the Charles Schwab is actually about 2.9%. And so we're looking at much higher yields there. And you can see some of those purchases with the reporting portfolio. And with that, I can answer any questions that you may have.
Mayor Pro Tem, any questions? Jason, Elena, with the uptick in inflation, we should see some of our fixed income assets actually starting to increase. Where do you see, since treasuries are such an incredibly important part of our portfolio, where do you see them going?
So if we think about that, and I'm going to have Elena make some comments too on that. I think when you look at U.S. Treasuries, I definitely think that some of the increases in interest rates have already been embedded in some of those the yield curve that you saw earlier. I think right now, if you look at very short-term securities like 3-month Treasury bills and things like that, it's really forecasting a wait and see, meaning that as the Fed continues to increase interest rates, those will continue to increase. I do think that the second half of the year does set up a little bit differently than the first half of the year as far as looking for interest rate increases. I think a lot of the communications have taken place probably since December of 2021, more into maybe March. So we've already seen that communication from the Fed. We'll have to see if the Fed is able to do what it says it's doing as far as increasing interest rates, because the last time that they were really on increasing interest rates, they were really not able to meet their objectives, meaning that the economy kind of turned on them in the middle. And so we'll have to see that. And I'll let Elaine answer that a little bit more and give her take on that.
Yeah, I'm actually very much in line with what you think, Jason, and thank you, Mayor, for the question. The one thing I would add is the Fed and the markets are looking at having a 50 basis point increase in both June and July, which if these things happen, we would be looking at a Fed funds rate of about 2.9% by the end of the year. So that's pretty high considering that we started at 0%.
That is pretty high. We have not seen 2.9 in how many years?
Very long time.
I think the last time we saw that was pre-2008.
All right. Well, I remember, I'm old enough to remember when they were double digit, but that was not a good thing. All right. We may be jumping ahead to the next agenda item, but looking at the portfolio and where the economy is today, do you see any opportunities for us to adjust our distributions in our portfolio?
I really think at this time, I think that working with staff, we've positioned the portfolio correctly. As we've had that new money, we haven't necessarily been investing it just all at one time. So we've been kind of taking our time looking for those opportunities. And so right now, I think when you look at the amount of cash that is available in the portfolio and some of the maturities that are coming off in the portfolio, I definitely think it's well positioned to take advantage of these higher interest rates. And Elena, I'm not sure if you have any comments on that.
No additional comments there.
Okay. Given that on a hyper-local basis here in Palm Springs, our economy has done very well over the last 24 months. And there's going to be, because of that improvement, a lot more attention given to how we are invested and where we're invested. So I think we need to be very prepared with talking points as to what our portfolio consists of and why it is the most prudent manner to distribute our funds. Okay. Any other questions from anyone? All right. Then why don't you go ahead and proceed, please.
One of the things I wanted to mention, with Chandler Asset Management, we have been working together. And when they first came on, I don't want to rush all these investments just to have investments. We were making some money in life. And so we decided the way the market was rolling to leave some more in life until we could make better decisions, until the interest rate increased. And we're glad we did that. because now it's paying off.
Good.
So one of the things I wanted to mention is that we have to bring the investment policy to council each year for approval. I'm planning on bringing this to the city council for approval on May 26th.
All right.
And last year, we included adoption of a socially responsible investment policy. And we worked very hard with Chandler, and we think we hit the nail on the head. At this time, we have all that included, and we're going to recommend no changes to the policy and to move forward with the adoption of it.
Right.
And I just want you to know that not only Chandler reviewed it, I reviewed it, and we're both in agreement at this time.
Right. May 26th certainly works. Councilmember Coors, who tends to pay close attention to these issues, is going to be absent on the 26th. So if you could do a early reach out to him with any information, I'm sure he would appreciate it and can funnel any questions he has through one of us.
Yes, we will do that. Thank you. And that's all we have for you today, unless anybody else has additional questions or comments.
Yep, none for me. Mayor
Great.
Pro Tem, shaking your head no, so all right. Jason, Elaine, thank you very much. And we look forward to seeing you probably in about 3 months for the next quarterly meeting. And with that, we will adjourn the special meeting of the Finance Committee at 1:43 in the afternoon. Thank you.
Great. Thank you, everybody. Appreciate it.